Well, hello folks, L.A. Little here with TA Today. What we're going to look at today is how to use neoclassical technical analysis to establish your trading bias. And you can do that both on a long-term time frame in day trading, which is your daily chart. You could also do it, of course, intraday, and we'll look at both of those. But the example I'm going to give you was a great example that happened on Friday. And let's switch over here and look at the charts. So here's the SPY, so it's sort of a proxy for your S&P 500. And what we have is a breakout on Thursday, right? That's the X here, or the arrow. It gets over that swing point high, gets over that one, so you break two of them. And so you move from bearish to bullish on that one move. Now, as it gets over that, that's a pretty good breakout, but it also goes over and closes back under this one, so you kind of get a failed break of the prior bar, but you had a little bit more volume. So I mean, all things equal, it still could go. But the thing in neoclassical is that when you get a breakout within two bars, probability very high, 80 percentile, that you're going to come back and retest this area that you broke out from. That's called the retest regen. And so when you know that on your daily time frame, which is your long-term time frame in day trading, you know that more than likely you're going to have to shift that bias from what has been up for the past week into either a sideways or potentially down type of mode coming into Monday and Tuesday. So that's kind of the backdrop. That's how you can use your neoclassical knowledge, which anybody can learn. You can read my books. I've written a couple books specifically on this. John Wiley published them. You can find them on Amazon under my name. Or you can get knowledge off the website or these videos. Now what I'm going to do is, let me show you one other thing. The Qs. So that was the S&P. Now the Qs, very much weaker, right? Haven't got over a swing point high here or there. So when you compare the two, they're not anything near the same. And so if I wanted to short something, I would probably be looking at the Qs. And in my particular case, when I saw that bullish breakout, non-confirmation, so you got the S&P breakout, you don't get confirmation from your Qs, then I'm thinking short coming into Monday. Now, that's not a day trade, but if you wanted to do something like that, you can, which is what I did. And so when I came into Monday, I'd already basically shorted the close, and there was a gap down. Now, here's where you get into a different set of day trading ideas, and that is that you're still using neoclassical. This is a swing point low. You've got a swing point high that was established here once we got 6 bars in. But that swing point low is broken on the very first bar on the gap down. Now it doesn't do you any good to see that unless you're able to grab something fairly quickly up here. But you already know that your trend has been broken to the downside. So my bias coming into Monday, if I'm not short already, is to think about shorts instead of longs. Now, if you look at Monday's trade here, there wasn't a lot of good setups on a 30-minute time frame. So basically, you got a gap down, you get some bounces, right? Another bounce over here that you could have shorted here because that's a failure, but you wouldn't have got much out of it. So on a 30-minute time frame, really not a lot to work with. The only thing you had to work with that was useful, which would have been going against your bias, was the break of this little area down here, right, that reversed back up. But let's go to the 10-minute chart, because on a 10-minute chart, we can actually see some setups. So here again, here's the break of this swing point low, a break of the next swing point low, and as we establish the trade on Monday, you can see the open was here, so a big gap down open, pops up, and then it starts to reverse back down. Now, if you go inside this to a 2-minute bar, here's the gap down, right, the open, right here. And then you make a low, come back up, spike up, volume spikes. So all that's good, and here's the fade. And the problem is you can't really trade that fade. You could trade that reversal. In other words, because your bias is down, you've got a short setup here with this reversal. So in other words, it pushes back up to try and go back up, and they just push it back down and leave a long tail. That gives you the potential, if you're trading it that way, to switch and get yourself a short, and you'd probably end up covering it somewhere over here when it reverses on it. Same thing here. You get a little reversal, and again, you got your day trading bias, so you can go short again. And then up here, you can't really do much until you get to this area over here. Again, the point is you want to trade with the trend. You establish the bias, the trend bias, by looking at your long-term time frame on a neoclassical read that told you on the SPY you actually had a breakout, non-confirmation on the Qs, and you know that there's a high probability it's going to come back within 2 bars. That gives you a setup that you can work with and have the right frame of mind when you come back into trading on Monday, and you can establish your positions on the right side of the trade. Okay? Hopefully that's useful, and give me a holler out and let me hear what you're thinking. Give me some comments. Take care. See you next time.